Now, as a way to bridge the gap from segment one to segment two, I think it's important to look at, and I thought this was a great chart from when the dollar bucks, what happens. And for those that have been following us, and we did a whole segment on dollar dynamics, because I think there was a misconception, especially back in 2020, of what was going to happen with the dollar. And our view was that you were going to get the dollar that was going to strengthen. And especially as we had this massive printing, and this is not just the US, this is globally speaking, there was a massive amount of printing. And inflation was going to be on the back end of that. I got into arguments or debates with people who said, "Oh, Mark, you're only looking at costs." It's like, okay, well, clearly you've never run a business, because businesses set their prices off of cost. So, but again, neither here nor there. So when you look at how countries and companies were going to try to manage their inflation, it was going to be on the back of the dollar. But when you look at dollar strength, that's typically what is an impetus for a crack, where somebody, some country, some entity just can't finance themselves. They then the stress becomes too much, and then you have a rolling default, a controlled default, an uncontrolled default, however you want to look at it. And if you look at the debt crisis, realistically, the dollar was lower. The global financial crisis, we're coming into this point, and normally you get this big dollar growth, and then you get this move down. Now, I actually believe that you could get a much bigger move higher. I don't think we're done at 107. I do think that there is another surge up, and that is when you're going to start to see that crack really start to increase, especially at the emerging market front, because they have an excess amount of US dollar denominated debt. And that's why this matters so much for two reasons. One, most commodities are traded in dollars, and two, they have a lot of dollar denominated debt, but they're in a different local currency. And the view was back in 2014 was, okay, well, the dollar's come down. The hindrance of getting people into our debt is that it's in a different currency. So let's simplify it and we'll issue it in dollars. Dollars are fairly cheap. The economy is expanding. This makes a lot of sense. And it did at the time, but now that you have a falling import, so you're no longer export, so you're not naturally taking in dollars, but you still have to maintain your dollar denominated debt by paying interest, that's where the pain starts to grow. And because of this, and because of the way the debt is structured, it's exponential pain. And that's why we think that there is a lot of problems when we're looking at how the dollar interacts with the rest of the market and the rest of the world in general. So then when you look at how this is going to continue to flow, and when you look at the dollar availability, we're going into quantitative tightening. So we're taking dollars out of the market for the first time realistically since 2009. We had some periods throughout, but again, the dollar was weaker at that point, so it wasn't as painful to see, I guess is the way to look at it. But the odds of a recession, or the probability model, continue to rise rapidly, and we actually think it's even above where this is. So, but then when you look at the liquidity indicators shown with U.S. recession bands, the higher readings indicate tightening liquidity. So again, you're still seeing this tightness in terms of available dollars because our inflation is out of control. And we'll show this in terms of sticky versus flexible. So even though the Fed pace may slow, essentially you're going to see this pain continue on the dollar side, which is again going to reverberate through the system, which is why I've always talked so much about shockwaves. I did a quick stint in the financial newsletter world under Shockwave Trader, because again, there's shockwaves. There's this ripple effect that happens, and it starts in one area, but you can go down the first, second, third, fourth derivative because it's going to move through the system, obviously similar to a butterfly effect. So when you look at the Fed minutes, there was something for everyone. There was something for the bulls, something for the bears. They essentially said that they're still going to raise rates because rates still have to go up, but the pace is going to slow because they want to have the lagging impacts of rate rises going up. And for those that have studied, historic Fed moves, they're trying to echo what was said by Volcker. So Volcker said that it wasn't the fact that he didn't think rates had to go up. He wished he did it slower, and he gave some pauses in between. And now, given it's hard to be a Monday morning quarterback because you're looking back to look at what things were, but you were in such a dire situation that you had to break the cycle. So the only way you can break a cycle, because as much as this is physical trading, there's also a psychological impact. You have to appreciate the fact that you have to rebuild faith in the Fed. You have to rebuild that faith. And the only way you can rebuild faith is by taking extreme measures. So yes, you could say, so right now, there's the Fed apologists and there's the people that look at the Fed and say that they've been reacting too slow. And again, this is something where and especially if you go back and listen to Volcker, he said that he wished he slowed at 16, 17% instead of going up to that north of 20. And right now they're making similar comments, and and we're not even above 2%. So again, the world has changed, and that's why I think it's going to be a pivotal issue in terms of how drunk we are on cheap debt, and why we think that the Fed is trying to show that they're being realistic, and the Fed funds futures curve actually shifted up. And that's something where we think it's going to stay higher, because now, based on these commentaries, and again, one of the things that we had said was on the futures curve, the Fed funds futures curve and the yield curve, we were going to get an inversion, and then the Fed was going to panic, and then we were going to get a massive steepener. And the steepener is not because we don't think there's going to be a recession, because we do, which should put a damper on future rates. We just think that inflation is going to continue to stick around because of the Fed inaction. And that's going to be supportive of rates going forward, which is why we see that coming through. Market expectations for Fed funds rates change between July and end of 2022. Still see raises. It's not that we're not going to see raises, but you can see it's pulled back in terms of how extreme. So, and that's something that we do think is going to happen. Now, in terms of the curve, you can see it's pricing in cuts in 2023. We still don't believe that there will be cuts, but again, that's something to see going forward. The SPACs mergers have been breaking up at a quickening pace, so not that. So this is from a tweet, not that spectacular anymore. I thought it was funny. I'm just saying it because it was. Liz from Fidelity had it out there. I think she's a fantastic follow if you're not following her. 42 SPACs have broken up this year as industry continues to struggle. Value of terminated deals adds up to roughly $4.3 billion and includes firms in the aerospace and space and tech industries, among others. So when we were trying to, and we continue to try to raise money for the private equity fund, somebody told us that they would only invest in us if we did a SPAC. And they were offering a lot of money, and it was in what we believed our best interest to say, you know what, no, we're going to turn this down. We don't want to go down this route. We think that there's a lot of issues with the way that they're structured. We don't want to go down this route. And right now, it was painful to do it then, but I think you're starting to see that there is a place for a SPAC. I'm not saying that there isn't, but it was abused, and that's where we didn't want to be just part of the mantra of we're just going to do a SPAC because why not? We want to, again, do things the right way. And I think you're now starting to see why this was such an abused market and how this money was left to flounder and how people essentially just abuse the system in general. So, but I should preface that with easy money is going away. And I think that the investor has to get comfortable with the fact that this easy money where you buy something, it goes up 5,000% and then you sell, those opportunities as the Fed tightens, as liquidity comes out of the market, are not going to be that readily available. There may be some unicorns within there, but again, that's where we're going to start to see some of this normalization and the flexible, and that's a good segue to flexible CPI. So core flexible CPI is reversing course and coming down, and it went up it's coming down just as swiftly as it went up. But a lot of this is on the back of gasoline. Gasoline is starting to, not so much, flatline, let's call it here, but diesel remains elevated. But more importantly, when you look at the U.S. consumer, natural gas and electricity is getting more and more expensive. So that's going to, again, keep this a bit elevated. It's fallen back to the other areas in which it's been, but flexible, as we were saying, was going to move around, was going to be very lumpy given just how robust the move in gasoline and diesel was. Now you start to see this come down and you're going to get this leveling effect. And I think you're going to see this remain fairly elevated. That compared to sticky. So even as flexible has come down, sticky, the rate of change has slowed, but it's still in an upward move. And this is where we continue to see the pressure. So when you talk about the Fed activity and their slowing pace, people are looking at that flexible and that headline piece. And we're saying that, to Powell's credit, and given he has thin skin, and if you start to badger him, he'll maybe change course. This is what keeps them up at night, is where is the sticky inflation? Where is that piece? Because this is the thing that doesn't cool off quickly. You have to go after the flexible. You have to bring that under control. But then how do you bring this down? And that's where real estate comes in. That's where wage growth, wage inflation comes in. And that's what they're looking at as we continue to see those two pieces moving in aggressive fashion. But as the real estate comes down, they inflated that bubble so much that it's going to be very difficult to deflate it without having a much bigger interaction within the world. All the while, and again, so even though flexibles come down, I think these are always great kind of, let's call, even though the respondents, you could see they're below 5,000. I just think it's important to look at what is the general trend. And I think if you put yourself in this, you're going to agree with what they're saying. And again, I think it's an interesting piece where over the past 12 months, have you become more or less price sensitive? And this is looking at back to school and buying. And July of 2021, 40% were more sensitive. But now in July of 2022, 62% said they're more sensitive. I mean, I like to think that I'm in a fairly healthy income bracket, and my wife has been very good in terms of, she's gone to Staples and Target and other areas trying to get the best deal for back to school. We have 3 kids going back to school, and it's a lot of money when you add it up. And when you look at some of these things, you're watching prices go up $1, $2, $3 on everything, and that again increases the pain, increases the underlying problem, which is why we don't see that changing, and we think people are going to be more and more price sensitive. Are you spending more or less on back to school items this year compared to last year? And I don't think it's surprising to say that 41% are saying they're spending more. And I, as you spend more, are you spending more on stuff? Are you spending more on different things? And I think that's where you're starting to see these pressure points and why people are trying to shop as much as possible, especially when you look at Amazon and beyond. So what's the main reason you plan to spend more on back to school items this year compared to last year? And 60% said prices have gone up. And my child needs more for school this year compared to last year. And again, as your kid goes from kindergarten to first grade or first grade to, that, yes, you'll need different things in different times. But in general, prices have gone up. And you're seeing it in school supplies, it's everywhere. And that is, even though flexibles come down, so yes, I paid less on gasoline to get to Staples or get to Target, but now that I'm in Target, everything is more expensive. So I saved on gasoline, but everything I saved on gasoline, I now not only spent more in Target or Staples or whatever I saved, which may have been, let's call it, $8, $10, I just spent an additional $25 in the store. And again, that's where, yes, flexibles coming down, but that stickiness, that is remaining to be the case, which is so is the Fed pivoting? I think they're trying to show that they're more in tuned than in previous times, but I don't think they have the ability to pivot right now, given where inflation is. Headline can move, but that sticky piece, again, the devil's in the details, continues to be that driving force. So on the positive side, manufacturing index for Philly Fed ticked up to 6.2 versus the estimate of -5. Remember, last month it was 12.3. So you're still getting a lot of lumpiness, but again, the trend is still down. And yes, you've gone back to positive. So new orders, shipments, inventories, delivery times, and unfilled orders all moved up. Delivery times isn't a positive. When you look at inventories moving up, that is depending on how quickly those will move. That is a negative. New orders is a positive. Unfilled orders is a positive. But the work week down slightly while employment moved higher. So you're starting to see that kind of mix. When you look at the NFP, the non-farm payroll, and some of these others, it's important to look at what is happening with employment. Some areas we're seeing a steep decline. Others you're starting to see this bounce. But nothing goes down in a straight line. And that's what we've said from the beginning, just like nothing goes up in a straight line. So we still see a downward trend based on the other aggregate information. But this is important to watch. What are we going to get from Dallas? What are we going to get from Richmond? Because the Empire State one was ugly. So again, it's a mixture of these different data points to get the real sense. But one of the important things going forward, the 6-month forecast, so 6-month outlook for unfilled orders component within August, Philadelphia Fed has plunged to the lowest since 1973. So even though you're getting some of that strong headline number, when, again, you dig into the numbers, you're starting to see a lot of slowdown, which is reflected in the CapEx spend. And again, it's not so much what are we seeing right now, because there's back to school, there's some of these positives that are seasonal, but when we look out going into Christmas, into some of these other areas, we see a lot of this pain and a lot of these slowdowns that is going to bleed into 2023, which is why we've said that we think we're in a recession now, but it gets worse as we progress through the year and into next year. And I think this is an important chart because in nominal terms, U.S. retail sales are still strong, hitting another all-time high in July, up 3.6% over the last 6 months. But after adjusting for inflation, real retail sales peaked in April 2021 and are down 1.1% over the last 6 months. So this is continuing to be the case. And again, the thing that's annoying or hard with the consumer, just like with real estate, it's slowly and then all at once, because all of a sudden there's going to be a number that comes out where it's just going to be kind of like a gut punch, where you're just going to say, where did the consumer go? And that's what we're seeing here. Again, it's slow. It's a slow turn. And then people, what seems like they get on Facebook or Twitter or a Twitter Spaces, and they come together and say, you know what, we're not spending anymore. And it seems like everybody has the same idea at the same time, and you're like, where did that come from? But it's slow, and that's why the inflation adjusted is so important, because there's value versus volume. The value of products is going up, but the volume people are walking out of the store with is going down and diminishing. And as we absorb that excess savings, as credit card bills continue to pile up, that's where you get that bigger pivot down. And we're starting to see it. And this is the transition into delinquency. You have auto loan delinquency starting to go up, credit cards starting to go up, the revolving credit starting to go up. So again, you're starting to get this pivot back higher. You're obviously well below where we were on pre-COVID, but it can catch up very quickly. And I think that's the key piece, especially when you look at 06 and 07, 06 and 07, and then obviously through 08, you can get a very quick move. And given that we have the most credit card debt in history, I think that you're going to get this happen quickly, especially because not only do you have the most credit card debt in history, you also have credit card rates going up at a very fast clip, which is just going to increase the pain. And again, this is why we see a lot of that pain continue. Auto loan delinquencies are concentrated in the South, and typically people stop paying their car loans first, and that's something that we see accelerating as well. And then the delinquency rates creeping up, especially in lower income areas, which isn't surprising. So credit card flow into delinquency by zip code, income quartile, we're coming back to pre-COVID levels. And I think that's the biggest concern now is when you breach that level. And again, this is that all at once moment. Once you breach it, I think you're going to explode through it because rates have gone up. And then if you just think about how credit card lending happens, it compounds. So the compounding impact at such an elevated rate at now a much higher number is going to accelerate those issues. And then that's why the consumer stress indicator, now this is a little dated in terms of this was from the end of last month, it's still elevated. So consumer stress indicator remains at 23% for the second month despite mortgage rates and gasoline prices falling significantly from June. The CPI release showed that the food at home component is now growing at 13%, which offset the decline in the other two components. So yes, you're starting to see now food come down a bit, but mortgage rates are coming back up a bit, and now electricity prices and energy prices are starting to come back in, which is going to keep that food component elevated, and again, keeping that gasoline side elevated. And that's why it's not so much that we see another surge up, because we don't. It's just, again, that sideways move, which leads to our comments that we've had about stagflation. So travel searches on the decline. Search activity related to travel has fallen lately, but there's a mixture of some of that is seasonal, and some of it is because of just pain. So it's not surprising that even last year in 2020, when you got to the end of August, you saw that drop. When you look at 2021, as you get towards the end, you see that drop off. So I don't think there's much to say here, but it's just something to keep an eye on. While the Zillow rent for all homes, rent pressure starting to cool a bit, but month-over-month change remains quite firm relative to history. So it's coming down, but again, the rate of change is coming down, but you're still seeing the rent index elevated, which is going to keep the CPI component of owner equivalent rent, OER, as well as that CPI sticky piece elevated as we continue. And that's why it's important to look at, and this is just bringing that chart back, retail sales report likely looks much less benign beneath the surface. Volumes bought are dropping, and this just gives you an idea of the acceleration, especially when you go further back into 2021. You can see just how much they've fallen while retail sales on the running price continue to go up. We're now significantly off of those 2021 highs, which was a lot of government money, a lot of government funding, and we expect that to continue to drop. So overall retail sales have slowed from 13.7% year on year in January to 10.3% year over year in July. But in inflation adjusted terms, retail sales are up only 1.7% relative to last year. In other words, while consumers' retail receipts are higher, they're getting fewer items. And this just, again, looks at where retail sales are and the monthly change. So again, not much to add here. I think the important one to look at is the retail sales were up 10.3% year on year in July, up from 8.5% growth in June in terms of retail and food service sales. So this is going to be because we think that at this point, the food service sales, as we get out of the summer months, that's where we see some of that additional drop off that's going to be more than seasonal. And that's where we see some of that pain. And what gives us that confidence is when we look at some of the University of Michigan data, despite slight uptick in consumer sentiment recently, confidence in being able to buy vehicles, homes, large household durables is firmly recessionary and hovering near the lowest since the 1980s. So you're still seeing that pressure in general. Though the manufacturing report from the New York Fed was dismal for August, services PMI ticked up, still negative at negative 4.4%. Business climate index little changed at 29.5 as companies viewed environment as worse than normal for this time of year, and employment growth remains modest to down, which is again some of the pressure that we're seeing. And back to what we've talked about with corporates moving down, that's where we continue to see this negative move. But still, July industrial production was at 0.6 versus the estimate of 0.3. Factory production was at 0.7 versus the estimate of 0.3. Telling comments, but then, so this is a positive, but then when you look at Walmart has canceled billions of dollars in orders. The CFO says Walmart CFO sees new price cuts on some goods to pare inventory. So yes, you have some industrial production, which is good, but now when you look at the largest buyer and seller in the world is cutting, that's where, again, some of those leading indicators of what Walmart has done versus some of the lagging indicators versus what we've seen is going to keep downward pressure on a lot of this underlying data. When you look at July housing starts, we're at negative 9.6 versus negative 2.1 estimate. So building permits were negative 1.3 versus the estimate of negative 3.3. So you're seeing, excuse me, so you're seeing, again, more of that slowdown in housing in general. Household savings reserve, you can see that 42% are saying that they're at under 40, these are people that are under 49,999,000. So the average has 2.9 months in terms of coverage. And then as you move further up the income scale, people have more time. So those who make over 100,000, there's on average, they have 7.6 months of household savings. But one of the things is this is from Q1 because the Q2 data hasn't started to matriculate. And as that comes out, we see this being pulled lower, it coming down to, again, that bleed down on savings, which we've talked about over the last few months. Empire Manufacturing Survey delivery times, you've had the full round trip. So again, this is going to be a benefit in terms of bringing some of that cost down. But when you look at wages, that continues to be kind of that stickiness that we've talked about. With a true collapse in August, Empire Manufacturing Index, it was expected to be at +5, came in at negative 31.3. Largest drop in history of the headline. New orders down negative 29.6. Work hours down negative 13.1. Employment down to positive 7.6. 6-month outlook ticks slightly up to 2.1. So there's that mix. But again, this is why we have to see all of the regional data, because right now you're getting some Philly showing one thing, Empire seeing another. We want to bring this all together and look at what are some of the data is really indicating on a leading index. U.S. Regional Fed survey, when you look at new orders, manufacturing diffusion index, it continues to point down and moving further into contraction, which is something that we are seeing. The Empire new orders is indicating something similar. So again, we see more contraction ahead when you start looking at the PMI data on the national level, just given the manufacturing, the new orders from the regional. The employee work week, you can see, is now in contraction in the U.S. In the Empire side, so what New York Fed looks at. CapEx expectations continues to move down. In some areas, it's already negative. You can see it's moving down in the negative, on a negative path. Still positive, but these are things that we continue to see downward momentum on. Unfilled orders continue to be negative, and again, more of the leading indicators in terms of pain that is going to continue into next month. U.S. prices paid coming down, still elevated, and one of the things that we've talked about is this staying at a fairly elevated side. Inventory to sales ratio signals contraction in manufacturing ahead, not something that we're seeing changing, a lot of pain that we continue to see, with reshoring mentions continuing to accelerate as we go through the end of this year, back to just kind of closing out with where we started, where we see more reshoring continue. But reshoring and nearshoring is going to be positive for Mexico, other areas within the ASEAN, as we continue to see the shifts from major organizations as they try to manage supply chain and cost, which is also going to result in bigger shifts, more pressure in some countries, and again, things that are going to be very interesting to watch over the next few years. That's what we have for you here. The next segment, we're going to go deeper into retail, into real estate, and where we see that heading into the next few, and really until the end of the year and beyond.